Thank you. Thanks to Exchange for inviting me. My name is Joe Mazumdar. I work with Brent Cook at Exploration Insights. We run an investment newsletter in the mining sector, mostly focused on junior mining. And so I was asked by Anna Sorin of the Canadian Securities Exchange to give a talk, and she wanted she wanted us to focus on NI 43-101 technical reports. There's been a lot of good presentations about NI 43-101s, a lot of detail on what's compliant and what's not compliant and how the thing works. What I'm going to do is basically talk to you about what we do, how we use it, and some examples of things we've seen in technical reports and what you can see as well. Is there an answer? I don't know, but basically we know that the 43-101 was born out of controversy and fraud, basically, in an effort to renew the investor confidence in the mining sector. We also know that projects really don't need fraud to fail. They can fail on their own. The tragedy really lies in the inherent risk of the industry. The geology, the engineering, the financing risk. There's a lot of risk embedded in the industry. There's a lot of reward, but there's also a lot of underlying risk. And for us, at Exploration Insights, the NI 43-101 is a very helpful document for us to discover what we call fatal flaws. And all that is a risk with a high probability impact, with a high probability and a very severe impact. Those are the projects and the companies we want to avoid. And like I said, the NI 43-101 technical document gives us some insight into that. Again, the 43-101 report's not perfect, but either is mining. So born out of controversy, we all know that the PreDAC fraud was the mid-1990s. I was in South America then. I was working for a company that actually was looking at purchasing it through Freeport at the time, the Busang deposit. So again, the idea here with the 43-101 was there was a strong desire to improve investor confidence in the sector because it just did not exist. So the idea was to get an independent, unbiased technical review. But it's very dependent on these QPs, these qualified persons, these consulting firms. They got to be independent, they got to be competent, they have to have some ethical or moral fabric, let's say. The reports we tend to focus in on are the resource statements, the PEAs, the preliminary economic assessments, or nothing better than a scoping study, pre-feasibility and feasibility studies. Those are the documents we look at. And these are the documents that the sell side, which I used to be a part of, use as a basis for their asset valuation. The problem with these reports for people that are not engineers, geologists, or technically minded, they can be cumbersome. I've read some that go well over 1,000 pages. And still, for us, they can be technically enlightening. So when I started doing a little bit of research on this, I found that PreDAC unwittingly commissioned the first NI 43-101. So when they were getting the reports from Freeport that the gold wasn't there, the CEO went out and asked for a technical audit. And so he used Strathcona Minerals, now a very famous consulting firm. And the basis of a lot of that infamousness or famousness was based on this. So they looked through all these reports. They looked at 175 core samples, and basically they said, this is a technical independent audit, and there's no gold there. There's been a ridiculous amount of falsification of assays at Busang. You've got nothing. That's really the kind of independent report you want. It's got nothing to do with how you say or what you say. It's basically, I want the truth. I'm going to do my job and give you what I think is the truth. And say, but here we get to a point where opinions can differ. So the same firm, Strathcona Minerals, for Pretium's Valley of Kings, is there a valid resource there? So they were doing a bulk tonnage sample. Snowden did the resource. Snowden is a qualified consulting firm out of Australia. They did the resource. Strathcona had to do the bulk tonnage sample. Basically, they tried to reconcile their numbers and they couldn't. And so Strathcona came out with a statement saying that there's no valid gold mineral resources in this deposit. So without a resource, there's no reserves, and without a reserve, there's no future gold production. This stuff is misleading. Okay, potentially fraudulent, but it's really not. The issue here really is about how you estimate this gold mineralization, which is very erratic, a very high coefficient of variation. It's very volatile. And so they used one method, which the Australians like to use, multiple indicator kriging. The problem is that this deposit is so high grade, if you use normal estimation methodologies, you would kill the deposit. And so this other methodology is the only way that would actually make a deposit exist. Whether that's good, whether that's bad, whether it's evil, I don't know. But it's not wrong. It's just that we're not going to find out until actually it gets mined. And problematically, they couldn't do traditional debt financing for this because of the volatility of the underlying deposit. And it hasn't been taken out either. So private equity had to fund this deposit. And so fraud really right now is not the big reason for disclosure issues. It's basically not understanding the rules, not following them, or not using industry best practices. But the underlying reason why the 43-101 was created has basically been solved, if you could say that. But is the 43-101 a truth document? No. So this is what we do. So basically, we look at points of to enter the market. Either we look at one stage where we're looking at grassroots exploration, where there's really no technical report, to something that might have a scoping study, and all the way up to a feasibility study. So when you're on this side, basically it's very high risk, but very high reward, and so it's like a lottery ticket. Whereas once a project gets advanced enough, so you start getting technical reports, the investors change. Now they want to know when you're going to get this thing into production. They want to know the metallurgy. They want to know the mining method. They want to know everything. They didn't want to know that here. But now what we're finding is for takeouts and potential investments by majors, they're asking for a lot of this information they would normally ask later, earlier. So they can get a fatal flaw early before they spend all that money on a feasibility study. So what do? So we source our information, like there's basically 5 major risk components that we look at. And I used to do this as a director of strategic planning with Newmont. We never looked at management because we were management, so that didn't really matter. But for us as an investor, management's very important. But the 43-101 is not going to help you there. Execution risk, how you build this project, that's very important. Again, 43-101 is not going to help you there. It's not going to help you with geopolitical risk. That's not going to help you to know how this thing's going to get financed. But technical risk, it can add a lot of value. So between the 43-101 and our own site visits, that's basically where we source the most information to find out if there is a fatal flaw in this risk component of assessing a mining company. So what is a fatal flaw? So any big company or any company, when it looks at risks, it looks at the probability of the risk of the event and the severity of the impact. And basically the fatal flaw is the red zone. And so when we're looking at this information, we're looking at your resource statements or your PEAs, scoping studies, PFSs, and feasibility studies. And a PEA, the big thing what companies use a PEA for is the big reason is that I can use inferred resources. I cannot use inferred resources for a PFS or a feasibility study because I need to form the basis for a reserve. And the only pool I can use is measured and indicated. I cannot add inferred. And so a PEA gives that company a chance to use the inferred. But the cost accuracy, plus or minus 50%, is quite ridiculous because you don't even know what you're going to build. And the engineering is less than 1%. When you get to a PFS study, most people that look at PFS study is that what you're trying to do is looking at 2 or 3 alternatives for how you're going to develop this thing. And you're going to advance them. Not quite all the way to a feasibility study level, but you're going to advance them to another set of criteria that you want to look at in more detail. And so you got to worry about companies that may go all the way from a scoping study to a feasibility study. So it suggests that they haven't looked at some of the alternatives in enough detail before they actually pitch them. And if you look at the PFS study, if this engineering is only 1 to 5%, but you've cut the cost accuracy in half, and the 5 to 25% engineering in a feasibility study, I've seen feasibility studies that have been easily over 100% wrong. And I'll show you them. So when is a feasibility study not feasible? So International Tower Hill have live and good open pit gold project in Alaska. About 9 million ounces of about 0.7 grams, so much less than a gram. So the October 26 pre-feasibility study had almost 50,000 ton per day, big open pit mining operation, 75% recovery. The gold production profile looks impressive at almost 300,000 ounces, long-lived mine, well over 20 years, and they lowered the capital by a third to just under $2 billion. But if you actually read their report, you would know that the all-in sustaining cost is higher than the current gold price, which is good in terms of the report, because the report actually tells you that. Because you don't have to look and see if it's fraudulent. It's not. It's telling you that the after-tax NPV at 5% is negative 550 million. How is that feasible? The internal rate of return is 0.5%. The life of mine is 23 years, and the payback is 1 year before the mine shuts down. So why is that a feasibility study? Phoenix, we all know about Rubicon, and getting the geology right is always critical. So in 2013, they put out a resource that was done by SRK out of Toronto. The Phoenix Gold Project hosted about over 3 million ounces, decent grade, about 9 grams. But then as they did more work on it and actually got underground, it was more geologically complex, a lot less continuous. Weak visual indicators, strong nugget effect. Some of this we knew already. And then in early 2016, the same consultants dropped the resource by about 90%, the same consultants. But between 2009 and 2015, Rubicon managed to raise about $700 million. It was funded to development, not with debt originally because it couldn't, because it only had a scoping study, because it could only have inferred, because most of the deposit was too deep to get into indicated, because it would be way too expensive. So they were funded by equity, a stream by Royal Gold, a reputable streamer, and afterwards debt by a reputable firm. Declared bankruptcy and now is trying to resurrect itself. Another one, this was actually a feasibility study. This was the Pan project, open pit heap leach Carlin type deposit in Nevada. And the feasibility study was done. It actually had traditional debt and equity. And so when you get debt and you're an equity investor, you go, oh good, they've got debt. That means the debt guy is actually looking for cash flow. So he's done some work. He got somebody else to look at it, which they did. And did some due diligence. So this project was funded through debt and equity, but when they actually started mining it, they looked at the blast hole samples, and the blast hole samples wouldn't reconcile with the resource. And so that they thought the sampling was wrong from the blast holes. Then the sampling wasn't wrong with the blast holes. Then they found out the actual resource was wrong. So you're in the middle of production, commercial production, you've got this debt to pay back, and suddenly you have no gold. And the other problem that they have is that that they started doing run of mine. So run of mine, like in a heap leach, you can crush it, or you could just do what you just blasted. And they were trying run of mine, but the feasibility never said to do run of mine. What they tried to do was skinny the capital and avoid paying for the crusher, which was another 15 to 20 million, and just do it run of mine, and then they were recovering nothing. And so you had the combined impact of having no grade and no metallurgy. You weren't recovering anything. So what do? You go bankrupt. But looks like they'll come back. Another one. This one didn't die, but this was another feasibility study. It was permitted. They signed $40 to $45 million of contracts at the end of 2014 to build this thing. It was another open pit heap leach deposit in Southern California. It was funded by private equity out of a hedge fund out of New York. right after the feasibility study, their own board asked for the resource to be redone. And then that resource was redone, and they found the veins were still continuous, which was a problem at Rubicon and a problem at Midas, at Pan for Midway. It was they were just narrower. So we have more dilution, reduction in the estimated resource and reserves. Not a fatal flaw. They still went ahead and did it. But in 2016, their press release basically reported an all-in sustaining cost of $1,800. Bombori, ore zone in Burkina Faso. We never owned this, but we liked the people. We thought the deposit was decent. And so one firm came out with information that this resource and the drilling was sufficient to basically give me this resource. This one's kind of complicated because Burkina Faso was having a coup, and in the interim there was an interim government, and Orezone wanted to get their feasibility study out and get the permitting done before the government changed because they could be grandfathered with the old law. And so they took the old resource, stuck it in a feasibility study, and pushed it out. But then for any lender to look at it, they wanted the additional 50,000 meters in the resource. And so they said, okay, we'll stick it in. We'll get RPA to do it because they're doing the reserves. We won't use SRK. So RPA went back, did everything from the bottom up. Orezone knew that the resource was going to change, but they had no idea it was going to change by 30%. So that was a big negative impact on the stock. It's starting to come back, but still, it's a big issue. Trust issue is a big thing in the mining industry. So what's the problem here is that these are only estimates. They're not nefarious acts. There's an implicit underlying risk for all these resource estimates, and the key word here is estimate. The risk is prevalent in the entire sector, whether it's a junior or a major. We're just trying to measure grade of a significant volume of rock with a sample no bigger than a bottle of Malbec. So if you look at this, there's 3 holes there, right? This is actually Goldcorp's slide. Not the writing, just that picture. So they thought that everything between those 2 dotted blue lines was ore based on those 3 holes. And then when they started drilling infill, they found out what it really was. So imagine the waste and the dilution involved, and when you came to the resource, once you found out what was actually going on. So resource is not only problematic, metallurgy is. And metallurgy is how you extract the gold or the copper or whatever from the rock. This is not Canadian listed, but this is a company we owned. And this is just an example of what can happen, and we had no idea. They already did preliminary metallurgy. They suggested that you can get 90% recovery from the sulfides using standard crushing and grinding. And then they came out with another report in November 2016 that suggested 20% of the gold was below that fraction and refractory. That also hurt the deposit. Because now, I tell you, people are asking, companies are asking, the ones that may acquire these companies, that kind of information earlier. They don't want a feasibility report. They don't want a scoping study. They just want a lot of detailed information on the specific risks they think that any project has. Bisha, Nevson, we owned Nevson. We sold it a couple of weeks ago. But the problem here is that this is a very good company, a very good bunch of operators. And some of this they knew, but they had no idea about the impact. And so if you look at it, I don't have a pointer here, but the top of the deposit is the oxide. And that's where they got the gold from. And so a polymetallic, volcanogenic massive sulfide is zoned. Gold, copper, lead, zinc. And so as you're going through that profile, the other thing they have to deal with is oxidation. And so you got oxide, transitional, supergene, and supergene is where your copper can be enriched. And then you get into the primary sulfide mineralization. And that's everything Nevson did at Bisha. But now the problem is that as they're transitioning between this supergene area and the primary area, which they've already built the plant for and did a technical report on, the problem is that some of that transitional still got chalcocite. And the problem with chalcocite, this copper sulfide, is it coats the sphalerite. Is that a problem? Yeah, it's a problem, but they didn't realize it would be such a big problem. What it does, it coats the sphalerite, it makes it float into the copper concentrate. And so the sphalerite suddenly shows up at the copper concentrate and no smelter wants it. So suddenly you don't have a saleable product. And that's a big deal for them. Now they have to change the way they mine, and now they have to change the way they blend and how they feed the plant, because it's not about grade blending, it's about chemistry. So in summary, the majority of these tragic project outcomes are not fraud, but linked to fatal flaws. Feasibility studies, again, for our liking, ought to be feasible. Bankable is a different thing, and nobody should call anything bankable until it actually is. The QPs, they tend to have a positive project bias, and we've seen that not necessarily in the last year, but in the last 3 to 4 years when there was actually nothing being built and no technical reports being written. These guys had to keep people employed, and they would take jobs. And the companies could squeeze them with respect to the resource or their cost estimates. There's a significant difference between lab scale test work and applying it to an operation. Just ask Allied Nevada. That's another one that went bankrupt. So the data within any kind of NI 43-101 technical report can help us find a risk that the QP might dismiss as not being important. We might find it to be important. So what we tend to do is not only read the report, but for any layman, you review the conclusions, the risks, and the recommendations in section in a 43-101, and you'll get a good idea of what they did find. And then you can ask the company, are they addressing that in their recommendations and their budget going forward? How are they mitigating or trying to look at this risk? But again, the technical report and the 43-101 is just addressing one component of those 5 risk components that we're talking about, any one of which could hinder the valuation of any mining company. All right, that's it for me.